Good morning, everyone. Thank you so much for joining us. We are excited about our next panel, and we are very grateful to have Elizabeth with us today. Obviously, we've had a little news this morning with the FinTech report, so we're excited to discuss all things FinTech and issues, of importance to the administration as well as to FTA. Just to give you a little bit of a background on Elizabeth, in addition to her current role as Special Assistant to the President for Economic Policy at the NEC, where she manages the digital assets, financial regulation and fintech portfolio. She also worked on the transition team as well as in the Obama White House on retirement security and financial inclusion. Prior to that, she served as the Senior Vice President for Growth for Capital One, which acquired United Income and Investment, a retirement fintech. And then she has her JD from Yale, as well as a Master of Science from Oxford and a bachelor's from Duke. So we are very excited to have her with us today. And are really just looking forward to having the administration's perspective on some of our important issues. So thanks so much for joining.
Thanks so much for having me.
So let's go ahead and start with the big picture, because I know, there are probably folks online and in the audience who may be somewhat unfamiliar with the NEC. So can you tell us a little bit about your role and how the issues in your portfolio impact the fintech industry, as well as sort of how the NEC interacts with federal and state regulators?
Absolutely. So at the NEC, our job is to coordinate the president's economic policy making agenda, working with stakeholders across the government to identify and make progress on key priorities. So to put it in tech terms, you could think of us like product managers for policy. My portfolio is a little bit different. I handle financial regulation, digital assets, fintech, many issues that fall under the ambit of our independent regulators. But we still have the opportunity to collaborate on matters of policy. The process around the President's executive order on the responsible development of digital assets is a good example. Several independent agencies chose to participate and to lend their expertise, and the resulting recommendations and reports were the better for it. Similarly, we had the chance to work with state regulators, like my former colleague Adrian, and get the benefit of their on-the-ground knowledge and what was working in their states to help inform what we should be doing at the federal level.
Thank you so much. That's interesting. And I should note, when Elizabeth and I first met a few weeks ago, we exchanged stories about sort of the role of NEC. I formerly worked at DPC, and sort of how that policy management experience can be a very interesting process. So thanks so much for sharing.
It absolutely can. We can have a whole much longer conversation about separation between NEC, DPC, CEA, all of that, but I'll spare our viewers.
So thanks so much for joining. You also, as I noted, worked at a fintech startup. Can you talk a little bit about how that experience informs your approach to policy at NEC?
Yeah. So during the Obama administration, I was very fortunate to get to know a number of fintechs who were using new data technology to provide better advice, better products, lower cost services to customers. And I was really excited by what I was seeing. This was 2015, 2016, still relatively nascent for this industry. And when the administration ended, I knew I wanted to be a part of this change, helping improve outcomes for consumers through products rather than through policy. So I joined United Income, which at this time was a seed stage company. It was employee number 15 in the WeWork with a fake brick wall. And we were building a company that aimed to use data technology to provide lower costs, more comprehensive advice to people nearing or in retirement, answering questions like, what age can I retire? How much can I withdraw each year? In what order I withdraw from my various accounts? How do I maximize my Social Security and Medicare, which compose a huge part of many retirees' incomes, and then helping automate that for them. As the head of operations, I helped build up that company over 3 years before we sold to Capital One. And now that I'm back in government, there's a lot I take from my time at the startup and in the fintech space. I think people underestimate how similar the White House can actually be to a startup. They're both very entrepreneurial environments where time and human capital are absolutely your most precious resources. And I was fortunate to work for a terrific CEO, Matt Fellows. And on a daily basis, I find myself leveraging the little things I learned from calendar blocking tasks that drive my colleagues crazy because it looks like every calendar is constantly full for every 15-minute increment, to the big things like how do you build and mentor and nurture a team. More generally, I think my time at the startup made me really acutely aware of the importance of promoting competition, as the report highlighted, of making sure that the new entrants can compete against the larger incumbents and really help promote innovation, competition, and ultimately better consumer outcomes.
Thank you so much. And I'll just add one difference, or one similarity between NEC and a startup is you also have a lot of late nights too. So
yes, it does. My husband is used to that.
Sort of in that realm, there's a lot of talk right now in the press about the economy and sort of what we're looking to the future on. And can you just talk a little bit about the Biden administration's view on the economic outlook here in America?
Sure. So needless to say, the economy today faces much uncertainty. But one thing I think really stands out, and that's the resilience of the American economy. The country's economic recovery has come a long way from where it was 2 years ago. Employment has rebounded, growth was a healthy 2.6% last quarter, and the labor market remains strong with unemployment near record 50-year lows. The economy has even made progress from where it was this summer. Headline inflation is down from its peaks in June, and the prices of oil and other commodities have fallen. This translates to real cost savings for American families. We've even seen progress in core inflation. Core personal consumption expenditure, or PCE inflation, was slower in Q2 than in the quarter before, and the latest CPI report showed welcome signs of moderation. It's certainly too early to declare victory, but I think we're really heartened by the progress we've made. The administration's goal is to continue to bring down inflation while not giving up the economic labor market gains we've made over the past 20 months.
That's encouraging news, I think, thus far. But we'll, sort of like everyone else, I think, continue to monitor and see what comes of it. But I think one of the key elements that you just spoke about a few moments ago was sort of the focus on competition as well. So how do you think financial technology, so especially in this economic environment, can drive competition, bring down costs, improve consumer choice?
Well, as you referenced, there is a 100-plus page report out this morning outlining the administration's views on that, but I'll just sort of keep it at a high level. I think promoting financial sector competition is a real priority for the administration. Over the past 40 years, we've seen massive consolidation in the banking industry, with the number of banks in this country plunging by 70% and many large incumbents dominating. And this consolidation has real impact on communities. When branches close, lending to local businesses falls by about 10%, and communities often see higher interest rates. Fintechs can play a really pivotal role in spurring competition, leveraging new types of data, technology, innovative business models, and bundling services and introducing new services in a way that can really benefit consumers. We've already seen tremendous growth in this space over the last 10 years, and we're seeing the results. Fintechs have given Americans more way to pay, and they've underwritten borrowers that have struggled to find traditional lenders. Of course, competition and innovation need to happen responsibly, and we'll continue working to curb fraud, disclosure violations, other practices to make sure that we can really reap the full benefits of innovation.
Thank you. And I think from an FTA perspective, we couldn't agree with you more on the benefits of financial technology. And just I think from our perspective, really are looking forward to working with you and others in the administration on some of these important issues as this effort moves forward. But in the lane of competition, one of the areas, of course, that we're very focused on is open banking and open finance. The president's executive order charged the CFPB to accelerate its 1033 rulemaking. How important does the administration think open finance is in driving competition and positive outcomes for consumers?
So as all of you know too well, the ecosystem around consumer financial data is highly fragmented. It creates significant barriers and benefits incumbents at the expense of newer entrants, which again limits competition. And allowing consumers to access and share their financial data can promote competition for consumer financial services and facilitate innovation in consumer finance. I saw this firsthand during my time at the startup. Of course, it needs to be done in a way that protects consumer financial data privacy. And we're incredibly excited that the CFPB has kicked off its proposed rulemaking on personal financial data under Dodd-Frank 1033. We, of course, deferred to the CFPB as an independent agency on the substance, but we think it's a really important step forward and in line with the administration's broader commitment to a more open and competitive financial system.
Thank you. No, that's a helpful perspective to have. And just for folks in the audience, of course, we will have someone from the CFPB talking about open banking and some of the coming panels. So we're looking forward to hearing a bit more about that as well. But talking about consumer privacy and data protection, they're also top priorities for fintech companies, and will be obviously a major focus here when we're talking about 1033. What does the Biden administration want to see from companies in the consumer finance space when it comes to safeguarding privacy?
This is something touched on in the report this morning, so I would direct you guys to that. But I'd say at a high level, we're aligned with the CFPB's view that safeguarding privacy requires both regulating data providers and the authorization of third-party data users. As the CFPB has said, we need to limit the ability of third parties to collect and retain data beyond what's reasonably necessary and prevent third parties from reselling it for unauthorized uses. In addition to such safeguards, as Director Chopra has said, the industry is going to need to work to develop standards addressing data security. Many data providers are already covered by GLBA safeguards, but the CFPB has said publicly that it's looking into whether authorized third parties may be subject to additional standards.
Understood. And I think, that's a helpful, we've all, I think, tracked very closely what the CFPB has said as well in the past couple of weeks on 1033. And I think it's helpful to hear a little bit also about the administration's perspective. From an FTA perspective, our members are generally GLBA compliant, as you just referenced. But what do you think the future of privacy policy is for the administration, particularly from a domestic and international perspective, as there are discussions on Capitol Hill about enacting privacy legislation?
Sure. So the president has consistently called for stronger privacy protections for all Americans, and especially for children, even featuring it in this year's State of the Union, which is prime real estate. It's our view that Americans should not bear the burden of trying to protect their privacy by clicking through onerous fine print policies that everyone clicks yes to anyhow. I know I'm guilty of that. We believe instead that platforms need to minimize how much information is collected in the first place. And we especially need strong protections for sensitive data like geolocation and health information, especially reproductive health information. We've been encouraged by the bipartisan congressional interest in passing privacy legislation that reflects these ideas. On the international front, we're pleased that we reached a deal with the EU on a new transatlantic data privacy framework, replacing the Privacy Shield, creating an improved legal basis for transatlantic data flows. And last month, the president signed an executive order implementing our side of the deal. So stay tuned.
Absolutely. I will acknowledge that since May 25th, 2018, I've been watching closely the trajectory of GDPR through to with the Schrems decision and then obviously the framework. So, we're excited for what comes next. And just from an FTA perspective, I think our members have recently just published some privacy policies that really, I think, track with a lot of what you just said as well. So, from an industry perspective, it's something that we are very focused on too. But switching gears just a bit, and one of the things I know FTA members are also focused on, particularly given their sort of non-bank role here, is access to federal charters, which really we feel could enhance consumer choice, et cetera, cut down on fees, drive competition. Various parts of the administration has called for a federal payments charter. How does NEC think about these issues?
Sure. So we are aligned with, as you say, non-banks, including many fintechs, can really help promote and spur competition, providing increased consumer benefit. But whereas banks are subject to significant regulation, non-bank payment companies are typically regulated at the state level, where there can be substantial variation between state regimes. And if these firms are not adequately regulated and supervised, there can be real risks for consumers or even impacts on financial stability. That's why a recent report by the Treasury Department called for consideration of a federal payments framework, which could help realize the benefits from non-bank payment providers while minimizing the risks. We're in the very early stages of working with the Treasury Department and other stakeholders on what this could look like. But some of the things we're taking into consideration are existing state and federal standards, the nature and risks of payment activities, and the very real developments we're continuing to see in the payment space.
No, that's helpful context, and I think we were all very encouraged to see the call for a federal payments charter as well. So, we're looking forward to hopefully engaging in the future on these issues. I think in the similar vein, one of the things we also sort of focus on is access to the Fed payment rails, particularly FedNow. We've called on the Federal Reserve and FTA to allow broader entity access to ensure, payment providers can access both that and Fed accounts and services. What is the administration's view on some of these issues?
Sure. So obviously, we defer to the Fed as an independent agency on how to manage access to its services, and know that they've recently put out guidance on this topic. I will say that we're incredibly excited about the launch of FedNow this coming spring and its potential to address consumers' needs and demands for faster payments. And we're excited this effort is going to help innovative companies, including fintechs that collaborate with banking institutions, build on top of the platform and really enhance the end user experience.
Thank you. No, and I think, in a similar vein, as we talk about charting and Fed access, the one other kind of element we've seen recently is that the SBA has recently proposed a rule to expand its 7A program to increase the types of lenders that can participate. I think we view this expansion to increase small business lending, particularly in smaller dollar and underserved markets. Can you talk a little bit about how this initiative came to be from the White House and NEC perspective?
Yeah, so as you say, this proposal is really part of the SBA's push to increase small dollar lending. And over the past 5 years, while the volume of loans the SBA guarantees through 7A has remained consistent, around $25 billion, the average loan size has increased substantially from about $400,000 to over $500,000, while the number of loans has then fallen commensurately. For example, the number of loans under $150,000 has dropped by more than 1/3, from 36,000 loans to 22,000 loans. And supporting small dollar lending is a priority for the SBA and the administration as a whole. It's essential for helping historically underrepresented businesses, in particular, as well as the smallest and oftentimes youngest businesses more broadly. So for this reason, the SBA has proposed issuing new 7A licenses to non-bank lenders, some of which are especially well positioned to make small dollar loans. This includes non-traditional lenders like fintechs that have already participated in the Paycheck Protection Program. And the proposal would also let community advantage lenders, which focus on underserved markets, participate permanently in 7A. These changes, along with other SBA efforts, should help more startups and more underserved businesses access capital, and we're incredibly excited about that.
No, absolutely. And I know, I think there's a lot of potential here, even from a membership perspective, that we're really looking forward to commenting and seeing where this discussion goes. Sort of staying in the lane of credit for just a moment, we talked a lot about how competition is creating more choice for consumers and expanding access to credit. And there's been a lot of innovations, particularly in the buy now, pay later space. How does NEC view the promise of innovations like BNPL to increase financial inclusion?
Sure. So again, going back to the FinTech report, sort of our guiding principle in all of this work is that new innovations can promote competition and provide better customer choice and services. That being said, that we think that new entrants need to be subject to the same oversight for the same types of risks. So let's take buy now, pay later specifically. It's grown rapidly in popularity in recent years, as folks in this room know all too well. And at their core, buy now, pay later products are similar to installment loans offered in the past by retailers and credit card companies. But here again, we're seeing competition benefiting consumers. As a recent CFPB report noted, many buy now, pay later products offer lower fees and simpler repayment structures than simple traditional alternatives. But more widespread adoption and entry of big tech companies raises novel concerns about consumer protection, data harvesting, and data accumulation. And addressing those risks is going to be really important as buy now, pay later continues to grow into a substitute for more traditional lending products.
That's helpful context, and I know, for our members, and I'll just say this broadly, I think we can say collectively that we are sort of very focused on the regulatory framework and making sure we're compliant, and also thinking just about the consumer and the end user as well, and how important safe products are, whether it's from a credit perspective or a privacy perspective, along the gamut. How important it is for us to maintain that trust from a consumer perspective. So, one of the things though, as we think about buy now, pay later, is really the fact that kind of the legacy credit scoring approaches don't necessarily account for buy now, pay later data. And how are you thinking about this and buy now and credit modernization in general when you're thinking about this?
Sure. So we all know credit scores are absolutely essential for accessing credit and economic opportunity more broadly, for purchasing homes, automobiles, for even finding employment. And far too many Americans lack a credit score. It's 45 million Americans who don't have one, and nearly 50 million more Americans who have poor credit, with many scores dragged down by factors like medical debt, student loans, or even natural disasters, which I know as a New Orleanian can reduce borrowers' incomes and raise their expenses. And sadly, when I gave similar remarks 8 years ago, the numbers were roughly the same. We haven't seen as much progress as we really would like to see in terms of bringing more Americans into the credit system. And we know that these consumers who either have no credit score or low credit scores are disproportionately young, low income, and underrepresented minorities. So how do we solve this problem and help more Americans access credit? So as you say, one approach might be to expand the types of alternative data that credit scoring firms use. The risk, of course, is that depending on the data used, you risk discrimination. And this is where federal authorities can play a hugely important role in helping coordinate credit score modernization to benefit consumers while minimizing these sorts of risks. And at the Biden administration, we've already taken steps in this direction. Just last month, FHFA announced that it would direct lenders to look at VantageScore alongside FICO. And the president's directed federal agencies to eliminate medical debt as a factor for credit underwriting. In July, major credit agencies also removed medical debt from consideration in credit scores, which is a huge step forward. These changes can make a really big difference for the many of the 43 million Americans with medical debt on their credit records.
That's helpful. And I think, we see so much promise in the credit perspective, from the credit perspective, on looking at different types of data and using it responsibly, but also really being able to get to some of those underserved communities. But we do want to also switch gears just a little bit as well to retirement policy. So taking a little sharp left, I know you worked on retirement policy now in 2 administrations, essentially. How do you view the role of financial technology in breaking down barriers to investment opportunities?
So as you say, I am perhaps biased because I have spent a good portion of the last 12 years in this space. But I think that investment advice, financial planning, is a classic example of where the fintech secret sauce, data, technology, new business models, can really disrupt an industry and bring huge consumer benefit. Investment management is traditionally relied on assets under management, or AUM, as the basis for charging customers. The result of that is that customers with more assets are more profitable and tend to get the lion's share of services. And fintechs have really democratized access to financial planning and investment advice using data technology. And not only have they sort of attracted a huge number of consumers, they've pushed the major incumbents. I mean, it's hard to think of a major financial services company that does not now have a lower cost technology-driven platform providing investment management financial advice. And that's a huge sea change from even 2010. I really think of it as the democratization of investment advice, and it's an example of the power of fintech.
Absolutely. If I think also about 2010, we barely had Google Maps and a few other things. So
It's true.
The world has definitely changed. So, as we think also, sort of turning, we've seen a lot of change on Capitol Hill in the last couple of weeks. I think a lot of us have been watching that very closely as the votes have come in. But, we also know that there are active conversations about legislation in the Senate, a lame duck session, maybe Secure 2.0, which requires employers to automatically enroll all new eligible employees into retirement contribution funds. What is the Biden administration's stance on Secure 2.0, and how are you engaging with Congress?
Sure. So we're certainly closely monitoring the House and Senate's work on this, and our legislative colleagues are regularly engaging with the relevant committees about this. And my understanding is that, as you note, Congress is working to reach a bipartisan agreement on a bill that draws from the various pieces of legislation that have been introduced in the House and the Senate. Of course, we've not yet seen sort of the product of work that the committees will produce together, so it's a little bit soon to say, this is in it, this is what's not in it, and we'll be waiting to evaluate that on the merits. I can say that the president strongly supports doing whatever we can to ensure that working and middle-class Americans are able to enjoy a secure and healthy retirement. And that starts with ensuring Social Security is strong and protected, but it also includes making improvements to IRAs, 401ks, and other retirement plans that help families save. So that's what we're looking for when we see the legislation. Does it help lower income and middle income Americans and not just high income and wealthy households?
No, that's great. And, I think we're all continuing to stay tuned to what happens next from a Capitol Hill perspective. So maybe just to end our conversation, we just had a midterm election, as everyone I think knows, that determined that, we think has determined the balance of power in Washington. How are you planning to work with the new Congress on economic consumer financial issues? And what are your priorities in this space for the next 2 years?
So I'm really optimistic about what we can achieve. Already in the past 2 years, we've gotten far more bipartisan work done than anyone would have thought possible. Last year, Congress passed the Bipartisan Infrastructure Law, which allocated over $1 trillion for infrastructure spending nationwide. This summer, Congress passed the Bipartisan CHIPS Act, which was landmark legislation investing $50 billion in U.S. semiconductor leadership, along with other measures to promote scientific research, innovation, and workforce development. And both parties have united behind key legislation in other areas, like supporting Ukraine and Russia's war. All that bipartisan work really speaks to the president's commitment to working across the aisle and behind the scenes to forge compromises where they count. So going forward, I'm confident the administration can continue to work on a bipartisan basis to drive forward progress in its economic priorities. These include lowering health care and energy costs and bringing down prices for consumers, promoting competition across a broad range of industries, as we've discussed today, and strengthening consumer investor protection.
Thank you so much. I just want to, conclude by thanking you again for joining us today. I think it was a lot of helpful insights, and I know some of us are looking forward to reading 110 pages after this event is over to get a better sense of where the report is. But I really appreciate you taking the time today to speak with us.
No, thank you so much for having me, and thank you for the important work you do. It's great to be back with the fintech community, and we look forward to continuing to engage with all of you and get your input and advice as we craft these important priorities. And piece of advice I learned from my last time in the Obama administration, that if you're facing a 110-page report, making yourself a bowl of popcorn while you read it makes it marginally better.
It's a good call. Thank you so much.